Hi, my name is Nikki Monto, and I'm a real estate agent here in Las Vegas, Nevada. And I want to help you buy a home. You either need to have all the cash up front to purchase a home, or you're going to need, like what most of us need, a loan. In order to do that, you're going to need a loan officer. Here is one of my good friends I'd like to introduce you to, who is a loan officer who's going to give us some tips and tricks on how the whole process works. Meet my friend, Macala.
Hi guys, I've been in the mortgage industry for 12 years now, and it's one of my passions to be able to help our clients get their goals of financing a home and moving into their dream home eventually. And it is a process, and so that's why you need a real estate agent like Nikki, you need a loan officer, and we're really here to collectively come together to support you in getting to your goals.
This is great. So the first thing that we need to do is understand how to get pre-approved. In order to go shopping with me and find the house that is going to work for you and your family, we need a pre-approval. So what does that look like, Macala?
That's a great question. The pre-approval process is really simple. So initially what we'll do is we'll do a phone call and I'll take down some information from you. We'll do an application. During that application, I'm gonna pull your credit and we're gonna see what your credit score is. From there, I'm gonna collect your documentation. So that's gonna be your income information, like your W-2s, your pay stubs, your tax returns. In addition to that, I'm gonna ask you for your assets. So that's your bank statements, your checking, your savings, your retirement, for instance, a 401k. So once I collect that information in from you, I'm gonna do your pre-approval, and that process takes maybe about 24 hours.
Great, so you're saying that once we get information to you, these basic things, then within 24 hours or so, we could then be shopping.
Exactly, which is so exciting.
Yes, okay, so in some of the things that we need in order to get pre-approved, credit score was one of the things you mentioned. What if somebody doesn't have the best credit score or high enough to qualify? Are there any things that you can help them do in order to raise that score?
Absolutely, yes, there are. So there's strategies of building your credit, which I'm happy to help you with. The minimum FICO score requirements for conventional is 620. FHA requires as low as 580, and VA goes as low as 580 as well. So there is a lot of room there, but if we do need help, I'm happy to help you get there.
Excellent. So I've heard that you can get approved for much more than what you actually need. So how should someone determine what their mortgage payment should be and what price point they should be looking for?
That's a great question. During the pre-approval process, I'm gonna discuss with you what you're comfortable with. Lenders can go up to 50 to 55% on debt to income ratio. That doesn't necessarily mean you wanna be there. So a lot of the time, I'm gonna have a discussion with you about what are you comfortable with for your monthly payment. A good rule of thumb that people use is 30% of your monthly income. So that could be a little high, that could be a little low in regards to your particular needs, but we'll go over that in that initial pre-approval stage.
That's great. I think the main point is that we want to put you at a place where you're comfortable with what your monthly mortgage is going to be. Even if you can be approved for more, we don't want you to be spending your entire paycheck on your house. We want it to be something that is going to benefit your family and grow towards your future goals.
Absolutely.
Once you get all the information that you need from the buyer, how long should they expect to wait before they know what they're pre-approved for?
Typically, it's about 24 hours. It's a pretty quick process.
That's great, which means we can go shopping even sooner.
That's right.
Rumor has it that you need 20% down payment of your purchase price to buy a house. Is this true in today's market?
No, that's not true. Actually, with conventional, you can go as low as 3% if it's your first time. So first-time home buyers are, obviously, they've never owned a home, but also if you haven't owned a home in the last 3 years, you can qualify for a 3% down. If you have owned a home in the last 3 years, then 5% down would be your minimum down payment for a primary home. If you're buying a second home or an investment property, the down payment is gonna go higher. Second home would be 10%, investment would be 20%. We also have government loans. So FHA and VA allow for also a very low minimum down payment requirement. So FHA is at 3.5% and VA allows you to go as low as 0%, which is great.
That's great. So one thing we really want to do in this pre-approval process is understand exactly what your situation is, because Macala's going to work to get you the best deal with the lowest cost of what those down payments are.
Absolutely. This only accounts for your down payment and your closing costs. So keep in mind, we do need to plan that out as well. So closing costs include lender fees, title fees, escrow account setup, and your appraisal fee. So escrow account setup is something I get a lot of questions about. What that is when you pay your mortgage payment and you have your taxes and insurance allocated to go and make those payments each time you make your mortgage payment, there's an account set up ahead of time that has all the funds saved so that it's ready to pay. So when we close on your home, we're going to collect for a year of taxes and insurance up front, and that is part of your closing costs.
Okay, so do you have any tips or tricks on how to save money for closing costs?
Yes, there are some strategies to bring down your closing costs. One option is waiving your escrow account setup. So instead of having your mortgage payment include your taxes and insurance, you can actually waive that, and we can save money on collecting that year of taxes and insurance. You're not really saving the money because you do have to pay for taxes and insurance throughout the year. But if we're short on funds to close and we just need that little bit to get you into that home, it makes sense. So we can waive about $2,000 off of your closing costs by doing that. Another strategy is seller credit. So in this market, it's about 50-50. Would you agree?
I agree.
So I don't pre-approve you based off of a seller credit. I'm always going to base it off of worst case scenario, we don't have anything. But let's say you do get a seller credit, we can apply that towards your closing costs. Another option that you have is a strategy that I've been seeing pretty often where you're offering a little bit more on the purchase price to get a bit of seller credit.
Yeah.
So let's give a tangible example. There's a property that's valued at $400,000. Your buyer is going to offer $395,000. There's $5,000 there that we can use towards closing costs by increasing the purchase price to $400,000 and asking the seller for a $5,000 credit. From the seller's perspective, they're getting the same amount of money, but our borrower is saving $5,000 up front on their closing costs, and it really doesn't impact monthly payment by increasing your purchase price by $5,000. So that's a great strategy to use. Last but not least, and this is really not common in our current market, but it probably will be soon, is by taking a higher interest rate. So if you take a higher interest rate, in some cases you can get what's called a rebate. That rebate can be used towards closing costs. So eventually, when our rates go down a little bit more in this market, we can probably start to see that trend upward.
Again, I just love how whatever the client needs, we're able to work with them and try every angle to make it so that they're saving the most money and getting really the best deal.
I think that's why we like this business, because you're able to be creative in your way when you're finding them a home and writing them a contract and talking to agents, talking to clients. And I'm able to be really creative in that puzzle piece of how do I make the borrower's financial goals a reality by coming up with creative solutions or coming up with products or whatever that may look like. We want to make sure that we're applying all of our skill set to helping our clients get to their goals.
Yes.
I think this is exciting.
Yes, love it. I would like to address the renters out there because many people are in a routine of renting, but what are the benefits for them to stop renting and purchase their home? Can you help give us some information about that?
I think that's a great question. A lot of people are considering right now, do the costs benefit them in the long run for purchasing versus buying or versus renting? In the beginning stages of renting, you just have that security deposit, right? And so a lot of the time people are comparing, okay, I have these closing costs as a down payment that I have to come up with versus I could just do a security deposit. But there are major advantages to buying versus renting. One would be the tax benefits. So your interest on your mortgage along with the property taxes are both tax deductible. Also, if you're a self-employed person and you use your home for business use, that's also tax deductible. So that's a one benefit.
Yeah, because so many people are working from home now.
Right, exactly. And you would want to talk to your CPA about the details of those pieces, but that's definitely
something
an option.
to consider.
Absolutely. Another part to consider is the appreciation of value.
Yes.
So you're buying something that is going to be an investment into your future. The Clark County appreciation rate right now is 10%.
Wow.
It's really high. So that's another factor to consider.
Yeah, huge factor.
Additionally, as you're paying your mortgage, your value is going up. You're building equity. Equity is the difference of your home value and the loan amount that you own. So let's say you own a home for $400,000. Your loan amount is $300,000. Your equity would be $100,000. So instead of paying somebody else's mortgage, you're gonna pay your own mortgage and you're gonna build equity.
Right. So essentially, every time you're paying your mortgage, you're putting that money in a savings account towards future things, versus when you're paying your renter, that money is gone forever. You're never gonna see it again. It just is helping you that month.
That's right. And also, landlords are not reporting to credit bureaus. So a lot of your FICO score is built off of your payment history for your debts. So that's a consistent payment that you're making that isn't benefiting you, not even on your credit side. It's not benefiting you financially, and it's not benefiting you with your credit.
So overall, renting is a short-term thing that helps, in situations, but as far as long-term goals and establishing, wealth for your future, buying and purchasing a home really is what is going to be the best for someone.
Absolutely, I agree with you.
Yeah. So we would really love to help you get there, and we get that every situation's different. Everyone starts from something different. So we need to hear your story. We need to know your heart. We need to know what we can do to help get you on that path to owning your own home.
Absolutely.
Now that we've established that purchasing a home is going to be more of a benefit for you than renting, do you have any input into the timing of when the best time of year is for someone to purchase? Should they be planning it in their year in a specific time?
I like that question, especially right now, because right now what we're hearing a lot is, I'm gonna wait until the rates go down.
Right.
Election is coming, I'm guessing the rates are gonna go down. And I think that there's a strategy here that a lot of people are missing. So let's talk about appreciation of value again. So we just talked about how Clark County is appreciating value at about 10%. It's a little bit over, actually. So let's go through a scenario where you buy now versus buy later, and let's look at the math. So let's say you're gonna buy a house right now. The property value is gonna be $400,000. Your interest rate, 7.125. And you're gonna put 5% down. The loan amount for that is gonna be $380,000. So your monthly principal and interest payment would be $2,542. And I'm only gonna compare principal and interest right now because taxes and insurance are gonna be the same whether you buy now or later. So we're gonna compare principal and interest only. Now, let's fast forward to December. And let's say that house is appreciated at its normal rate of 10% annual. That house is now worth $420,000. And we're gonna put in an offer. You get the house for $420,000 and your rate is great. It's 5.99. Your loan amount is gonna be 5% down payment. So that means it's gonna be $399,000. And your principal and interest is gonna be $2,387. The difference between the first and the second scenario is $150 per month, but you're buying that house for $20,000 more. It would take 11 years for you to break even on that.
Wow.
So it makes sense right now for us to buy the house while you have it at a low value, and then let it build and appreciate like we know we want it to, and then we'll refinance you when the rates come down.
Right, right. That's great. So what you're saying is, purchasing if everything lines up, purchasing sooner rather than later and not basing your decisions off of the rates is really a wise thing to do in this market.
That's right, Nikki. And really what I think we should consider right now is the inverse relationship of interest rates and home value. So in Las Vegas, we're so low on inventory right now. So we're not concerned about the values just dropping. We know that they're going to continue to appreciate. And what I think is important is as those interest rates come down, there's going to be more buyers in the market, and that's going to drive the prices up even more. So I'm going conservative. I'm saying nothing's changing in our market. We're just going to do 10%, and you're buying that same house for $20,000 more. I think it's a really important strategy to start here, take the higher rate as long as you're comfortable with the mortgage payment, and we're gonna be so much happier in 1 year, 5 years, 10 years, because we've gotten that house at a lower cost, and you would have saved yourself thousands of dollars.
That's great. Macala, this has been so helpful. Thank you so much for spending time with us and sharing all this insight. Is there anything else that you would like to share before we finish?
You know, this is one of the biggest purchases of your life. It's so important. And over the last 10 years, I've been able to help a lot of people get their goals of financing their homes and walking through the front door and now it's theirs, and it's just the best feeling. And I just want to reiterate that it is possible and that a lot of people disqualify themselves unnecessarily.
Yeah.
And so what's so important is that you connect with a loan officer that is creative and that wants to do that work to help you get qualified. And so if you're interested in that, if you want a little bit more information, my information is below and I would love to talk to you.
Thank you so much. So like Macala said, we're here because we really care about the client. We really want to help you reach your goals. So reach out to us and let's see what we can do of making home buying a reality for you. Thanks, guys. Thanks, Macala.